With sales up and listings down and prices, flat down in some areas, maybe slightly up in some areas, I often get the question, how is that happening? How are sales up, listings down, so it's tighter, but yet prices are still flat or, slightly declining? Stick around to the end and I'm going to explain why that happens. Midtown Toronto, which, comprises of Bedford Park, Lawrence Park, Forest Hill. Here are the June numbers. 85 homes sold in Midtown in June. New listings were at 192. Months of inventory is at 4. The GTA average is 4.7. City of Toronto is overall is 4.7 as well. So Midtown at 4 is meaningfully tighter. You have less supply relative to demand here than almost anywhere else in the market. Average days on market in Midtown is 25. The GTA average is 29. Homes in this neighborhood are selling faster than the broader market, which tells you buyers are engaged at making decisions quickly when the right property comes up at the right price. The MLS HPI composite benchmark for Midtown was 1,952,600, which is down, again, 0.14% year over year. That's essentially flat, especially when you're looking at a lower number of sales. Obviously, the stats can skew a bit, but it's basically flat. While the GTA is down 5.4% and the City of Toronto is down 4.3% on the same measure. Midtown is within basically a rounding error of zero in a market where most districts are down 4 to 13% year over year. And that's the definition of a resilient neighborhood. The detached market in Midtown really drove June's activity. 58 detached homes sold, average price of just over $2.4 million with a benchmark of $2,509,000. The detached benchmark is down 2.29% year over year. And there is some price adjustment even here, particularly at the higher end. So the sales and listing ratio trend for Midtown is 38.8%, which is above the city average. Condo apartments in Midtown, 17 sales and average around 955,000. The condo segment here is also feeling the broader market softness, consistent with citywide patterns. For buyers in Midtown, the sale to new list ratio is 96%. Average days on market is 25. So you're negotiating, but not dramatically. Tighter inventory means the window is narrower than elsewhere in the city. If you've been watching this neighborhood waiting, that wait is getting more expensive in terms of competition, not less. So for owners, you're in the best performing segment of one of the best performing neighborhoods in Toronto, right? So while most of the city is given back meaningful value, Midtown is holding within a fraction of last year's prices. So let's look at the macro picture here. And there's actually some improvement here worth noting. The Bank of Canada overnight rate is at 2.3%, held flat at the June announcement. Prime rate at 4.5%. Mortgage rates on a 5-year fixed, you get it in the low 4s right now. The Toronto employment picture improved in May. Unemployment rate came down to 7.6% from 8.1 last month, and employment actually grew 0.7%. GDP Q1 2026 came in at negative 0.1%, so still technically contracting, but much better than Q4 2025's at 0.6%. So the economy seems to be stabilizing. One thing to watch, inflation ticked up to 3.2% year over year, so that gives the Bank of Canada less room to further cut in the near term. So the rate environment is likely stable, not dropping further significantly, which means buyers should expect materially cheaper financing in the next few months. The setup, I guess, improving employment, stabilizing economy, stable rates, tightening supply. That's the combination that drives the second half story that Treb is calling. So what does June tell us about where we are now for buyers? So for buyers, it looks like the window is slowly closing, not dramatically and not yet. You still have negotiating room. Average days on market is still 29 in the broader GTA, and sellers aren't in a panic. But every month of data in 2026 has pointed in the same direction. More sales, fewer listings, less inventory. Prices beginning to stabilize. June added a month over month price increase to that list. The trajectory is seems to be clear. Treb is calling for renewed price growth in the second half. If that's right, the buyer who moves in July or August is in a better position than the one who waits until the fall, maybe. For sellers, this is the best market read we've had in probably 18 months. The rate of price decline is shrinking every month. Sales momentum is building. If you've been waiting for a clear signal before listing, this is about as clear as it probably gets. Price it right for current conditions and your moving product. The cost of waiting another few months may be that you're listing into a market with more competition from other sellers who read the same signal. Why are prices still falling? Supply down, demand up. Basic economics says prices should be rising. So, what's going on? And it's a great question. And the answer tells you more about where this market is actually headed than the headline numbers do. So let me walk you through that. So the key concept is this: sales volume and listing counts are leading indicators. Prices are a lagging indicator. They respond to conditions, but with a delay, sometimes months. And right now we're sitting in that delay window. Conditions are changing. Prices just haven't caught up yet. So let's go through the reasons why this happens. So reason number one. First, the inventory picture is less tight than it looks on paper. Yes, active listings are down year over year, and that sounds meaningful, but the number of homes still available across the GTA is still quite substantial. In a genuinely tight market, that number is 10,000 to 12,000. The year-over-year comparison looks, good. The absolute level is still high. As long as buyers have real alternatives, they negotiate. And as long as buyers negotiate, sellers accept, right? That dynamic keeps prices moving, sideways or down even as the trend improves. So reason number two, the key market ratios haven't really crossed the threshold yet. The sales to new listing ratio is still below 40%. And that's technically a buyer's market. Months of inventory, depending where you are, was still in the mid fours. Prices typically don't start rising until that number falls below 4, and they don't accelerate until it's below 3. So we're headed in the right direction, but we haven't crossed into seller's market territory yet. And until we do, sellers don't have the leverage to hold firm on price. Reason number three, sellers price based on recent comparables, and those comparables reflect Q 2025 numbers and Q1 2026 numbers, a weaker market. Even as conditions get better today, it takes 3 to 6 months of new transactions to shift expectations. Sellers need to see it happen around them before they have the confidence to hold their number. So reason number four, there's still a pipeline of sellers who are pricing to move, not to maximize. You have pre-construction condo closings, investors carrying negative cash flow, assignment sales. Like, these transactions are happening at discounted prices, and they become the comps that set the ceiling for what everyone else can ask. Until that pipeline clears, it keeps downward pressure on the market. And reason number five, buyers are still cautious. Affordability is still an issue. The Bank of Canada has been cutting, but they held, but the 5-year fixed rates are still in that low 4, maybe mid 4, depending on your qualification. And on a $1 million property, that's still a significant monthly commitment. Although unemployment was better, it's still not great. There's still contraction in the market. Buyers haven't forgotten what happened in 2022, and so they're not rushing. So here's a framework I'd put around all of this. Tightening conditions are the ignition. Prices are the fire. So you turn the key, sales pick up, listings drop, but the engine still takes time to warm up. That's where it seems we are right now. Like, the ignition is on, the fire might be coming. Treb is forecasting, a better second half, and leading to, price recovery in 2027, which means the most important window isn't when prices are rising. It's probably right now, in that gap between the signal and the outcome. Because by the time recovery is visible, the opportunity is gone. And that's not intended to rush anybody. It's just kind of the way it works. If you're in Midtown Toronto, Bedford Park, Lawrence Park South, North, Yonge and Egg, and you want a straight read on what your home is worth or where the opportunity is as a buyer right now, reach out. DMs are open. Link is in the bio or in the description. I'm in this neighborhood every day. Talk to you soon.